All right, guys. So we're going to receive today Jake Peck. He is our maximum amazing person liaison at National Life, and today he's going to talk to us a little bit about the National Life annuities. But the training today, I asked him to be something very, very practical, showing us like situations. I have somebody that wants accumulation, age X, and what kind of product is the best. So he's going to give us an overview of the products that National Life have. And just so is this on the recording, I'm going to once more tell you guys what Gustavo asked me to ask you. We're going to use annuities in two situations. One, if we have rollovers to do from 401ks or IRAs or some kind of product that the guy is losing money, we can do a rollover to the index annuities. Or if we have a client that it is not healthy enough to get an IUL, because if they are healthy enough, our first option always is going to be IUL first because of the living benefits and everything else. All right. So with nothing else to do other than welcome Jake, and thank you, Jake, for your time today.
Absolutely. Thank you, Claudia, for reaching out and scheduling this. And thank you all for being on today. So Claudia was spot on there. So I am tasked today to give you guys a little bit better understanding of the annuity products that we have at National Life Group, where they fit. Hopefully coming out of this meeting today, you will have a better understanding of when to use each of our different products. I'm going to go a little bit into how they work, just so you have that base knowledge of how the products work, but I really want to focus on when to use which one. If you look at our overall annuity portfolio, we have over 15 different annuities. That makes it very complicated and confusing for not only you, but your client as well on what am I getting and when should I be using this product if you're looking at it from sorry, I think I'm sharing the wrong screen. From a use case standpoint. So I'm going to go high level really quickly on what all of these annuities share. So we're going to talk about some of the index strategies really quickly and some of the features, and then we're going to get into some of the different use cases for these products. So hopefully you all are all familiar with IUL products, right? So we have index strategies. We've got a floor of 0. We've got upside potential. I'm never going to lose money within these products. It works the same way as a life insurance policy. I'm going to be stair stepping. As the market goes up, I get that gain. If it goes down, I'm going to go straight across and go up, straight across, up, straight across. That stair step that you guys are taught through your Money 101s and everything like that you get from Five Rings and Alliance Group. So with these products, they still have the S&P 500 strategies. We also have the volatility indexes. So just like you have the US pace setter on the IULs, you've got your balanced trend index. We've got a US fundamental and a global balance index. I would say the best recommendation I can give you all for these types of products is do what you're comfortable explaining, and that clients recognize the S&P 500. It's the easiest way that we kind of measure the overall health of the economy. If that's what you're comfortable with, stick with the S&P 500. Go 100%. Or if you've got a little bit more of a savvy client, then diversify a little bit. They're going to work differently in different market environments. The best thing that you can do, though, is have something that you can explain to them well, that they will understand and that they'll recognize, and not do 100% into one of these volatility indexes. If it's somebody's 100% of their retirement income and you're not sure what it is, pivot, go to the S&P. So one other feature that we have with these single premium annuities is that we're able to dollar cost average them. Now, what I mean by that, we have the same thing on our life insurance policies. It's called systematic allocation. If I put a lump sum dollar in that policy, it's all going to be tied to that time frame for my crediting a year later if I were to just do it all at one time. So same thing with an IUL. If I put $100,000, or in this case, $120,000 into a policy, it's all tied to, we're in July right now, it would be July. And then July of 2026, I would receive crediting or a 0 if the market's down. It adds a lot of risk to it. Traditional single premium annuities, that was your only option. You put your deposit in, it's tied to that one time frame of that year, and then every year you're going to get one chance at an interest credit. Dollar cost averaging just spreads it out over the year. So instead of one bucket of money, now I have 12 buckets of money that are all earning interest and getting crediting at those certain points in time. So 1/12 of my money goes in my July bucket, 1/12 goes in August, September, October, all the way through the year. So in this case, I got $120,000. We're going to take $10,000 and put it in the index each and every month. So that way you spread that risk out for that client. I can't tell you how many times, at least on the older products, you see big deposits, $500,000, $1 million, a couple $1 million, and they get a bad month and they get zero for that entire year on that large lump sum of money. It's a way for you to avoid that and a way for you to protect the client on October's historically a bad month in the market. It's a way to avoid those historical bad months and spread it out so you eliminate some of that risk. So this is not a requirement. It is an option. You can choose it. The minimum that we need for a deposit is $60,000 to use this. Now, our annuities go down to $25,000 or even on the lower end on our flexible premium annuities. So just remember that if you've got that deposit over $60,000, you can use this dollar cost averaging feature. All right, so I'm going to get into products now. So I want this to be as interactive as you guys need it to be. So stop me, ask questions as I go through these. Like I said, I'm going to go through each of the products and then a different case study for each of these products. So you hopefully realize where you can place some of these products for your clients. We really break our single premium products down into two different categories: accumulation and income. And then between those accumulation and income options, we break it down even further. Do you want a bonus? Or do you not want a bonus and you want higher rates? It's that simple. So accumulation, income, bonus, no bonus, but better caps. So on our accumulation products, we have our Zenith growth and our growth driver products. You can see based off of my time frame, the bonus products are going to be better for people that have a shorter time horizon. My Zenith growth products are going to be better for people that have a little bit longer time horizon. So your growth driver is going to provide a 7 or a 10% bonus, depending on the product you choose. Zenith growth, there's actually a Zenith growth 5, 7, and 10 now. It's just going to provide better caps, better participation rates. They've got more opportunity for long-term growth because of the compound interest that they're going to get. So if I look at these two products, growth driver and Zenith growth is going to work better for somebody with a longer time horizon. And I'm talking about longer than 10 years. If I'm going to hang on to this annuity for 10, 15, 20 years until I retire, the extra couple of percentage points that I'm going to get from my cap will be better than me getting a bonus today. Now, growth driver, on the other hand, you're going to get an immediate bonus right into the cash value of the policy. I put $100,000 in. If it's growth driver 10, I've got a 10% bonus that goes directly into my accumulated value. That's better for those people that need that extra time to catch up, get that bonus, and help them jumpstart their retirement. So all about time horizons, short-term, long-term. Am I close to retirement or am I further away from retirement? And that's true for the income products I'm going to get into as well. So Zenith growth really is it's plain Jane indexed annuity. It is the easiest one to understand. There's really no bells and whistles or special features on this product that you're going to get. It is just pure upside potential. There's no fees to the product, so they're not paying anything for this. It's just better caps, better participation rates than what you see on our growth driver product. There are 2 riders also on these annuities. And you think about the puzzle that we have, our living benefits that we have at National Life. We kind of have those on the annuities as well. So use that to your advantage as you're going through that presentation with the client. Now, if I die too soon with an annuity, I have the cash value that's being left to my family. If I live too long, we can create guaranteed income with annuities. But if I become sick, I do actually have 2 riders on our annuities that can help me out. There's our nursing care rider and our terminal illness rider. Terminal illness for the annuities is that I have a life expectancy of 12 months or less. So a little different from your terminal illness with your living benefits on the life insurance side. What that will do is it will waive surrender charges and allow the client to access $250,000 without surrender penalties from National Life Group. The nursing care rider, same type of scenario. We're waiving surrender fees and allowing them to access that 250,000 as long as they're confined to a nursing facility for at least 60 days. So if they're consistently in a home receiving care in that nursing care or long-term care type facility, we'll allow them access. So it's all about liquidity. And then if they have a triggering event like that, we don't want to hold their money hostage at National Life. We want to give them access to it when they probably need it most. All right, so with growth driver, this is where, again, it's an accumulation product. I don't have any fees on these accumulation products, but I'm giving up a little bit of the cap that I would receive, say on the Zenith growth, for a bonus on the front end, like I said before. So there's a 7 and a 10-year surrender period on these for an option on this product. Depending on that surrender period, that's going to determine your bonus. The shorter surrender period, 7% bonus. The longer surrender period, I get a 10% bonus. I will say it's all about your client's time horizon, and that this product to me compared to Zenith Growth, like I said, is for those individuals where I've just switched jobs. I've got an old 401k. I've got money in a money market account somewhere. You know, I've had an Edward Jones or Schwab guy and I'm done with them and I want to move my money out. But I'm in my 30s, 40s, 50s, and I've got a long time before I'm going to retire. Zenith Growth is going to be the better option there. Growth driver, on the other hand, in my eyes, is for those people that are within 10 years of retirement, where we're really trying to super fund a policy for them and get as much cash value in a short amount of time. That bonus will work really well for them if they have 10 years or less before they're going to start accessing the funds. Now, with all of these products, it's important to remember there is a surrender schedule to them. Just like your IULs, there's 10 years where I don't have access to all of my money. With annuities, you do have access to 10% of that money, though, without penalty from National Life Group. The other side of that is the IRS and taxation with these. So unlike an IUL where I can just take a loan from a policy at any point in time and it's not taxable, with an annuities, we have to worry about taxes. And that if I'm younger than 59 and a half, whether it's pre-tax money or after-tax dollars, if I've got a non-qualified annuity or an IRA or a Roth IRA, and I pull money out before 59 and a half, I'm paying taxes and then the IRS is penalizing me 10% as well. So it's important to understand that when you're having those discussions with your client that National Life will give you 10% without penalty. That is not mitigating anything that the IRS says, though. The IRS will still get their taxes, and if you're younger than 59 and a half, they will still penalize you that 10%. But National Life, we will give it to you. Now, growth driver, why I bring that up is, again, less than 10 years before I'm looking to access the funds. So if I'm 60 years old and going to retire in 5 years, this is a great use case. I can take a 10-year product, wait 5 years, and then start to pull at least 10% or less out of that policy without penalty from National Life. I'm still going to pay taxes, though, depending on the type of plan that I'm in, if it's IRA, Roth IRA, or non-qualified. So just be aware of those rules and study up on those as you're getting into the annuity space. So with growth driver, like I said, 10 years or less, those people close to retirement, doesn't necessarily have to be that, though. If you have somebody, and again, this is more for you're in a competitive situation, maybe with another carrier, bring it to me, bring it to Lindsay, bring it to our sales desk, or call Jared Weiss at Alliance Group. We can help find the best product that maybe fits. You know, you might be up against another carrier with a big bonus, and that's what we have to do to win that case. This product will still work for somebody that's in their 30s or 40s. It's just not going to be as competitive long-term for them. So if you have a weird case, come to us. But like I said, run with what's my time horizon? More than 10 years Zenith, less than 10 years growth driver.
We have a question on the chat, Jake.
When the client's 65 plus, there's no penalties. It depends on when they purchased it. So again, there's the the two of us that we got to worry about, the IRS and National Life Group. If they've had the policy and they're still in the surrender period and they pull more than 10% out, then yes, there would be a penalty from us, but not national or not the IRS. If they're over 65, they're not going to have to worry about the 10% penalty from the IRS. It's really just the surrender period for us that you have to worry about and how much money they're pulling out of the policy. So over 65, it's really just a matter of, are they pulling more than 10% of their money out? All right, so hopefully accumulation product made sense. Those are pretty simple. It's really, like I said, that stair-step story. It's upside potential, downside protection. I've got no fees on these products. I could have a bonus. I could not have a bonus. I might just get better rates to it depending on which product they choose. No problem, Pierre. So with the accumulation products, again, they can be used at any age. That's just my recommendation, though, on when we should be using them. In that I got a younger person, Zenith growth is going to be a better option. Somebody closer to retirement, growth drivers probably going to be that better option for them. All right, so with our income products, this is where it gets a little bit more complicated. So please put stuff in the chat if you need me to reiterate something or go over something again. These products work a little bit different than the growth products that are really, really cut and dry and pretty simple. We have our income driver and our Zenith income. Now, these both come in 7 and 10-year products as well. I don't see a use case for the 7-year products. I only talk about the 10-year products, though. You get better rates, better income. So one is really about guarantees, and the other is really about being optimistic about the upside potential. You know, kind of the same story as an IUL. So Zenith income to me is kind of that IUL replacement on the annuity side. I'm really optimistic. I understand I'm going to get some interest credits. I'm going to get some years that are zero, but I'm confident my cash value will support my income down the road. Income driver is really about, you give National Life the money today, we're going to be able to tell you what your income is going to be if you wait 30 days, a year, 5 years, 10 years, anywhere in the middle. We can tell you exactly what that dollar amount is going to be for your retirement income. And I'll get into those. So one thing with Zenith income and income driver that we changed, if you have been, I know you guys haven't sold a ton of annuities with us on the team, but just know that they can start income as soon as 30 days after they purchase the policy. That's not the norm in the industry. Most of the time you have to wait a year and then you can start accessing guaranteed income with these income products. So big change, nice shift for those people that are early or close to retirement that are like, hey, I need my money 30, 60, 90 days from now when I'm going to be out of work. We can help accomplish that now with our annuity products. All right, so we're going to start with income driver and kind of go through a case study with it. So income driver, like I said, it's a truly guaranteed product. So you have 2 accounts basically within this annuity. And that's, I think, the best way to think about it. You have your cash value on one side, and you have what we call a benefit base. It's really just an income calculation. There's no dollar figure to it. It's just how National Life is going to figure out how much we're going to pay you from a guaranteed income standpoint. So the cash value is going to grow based off of how that index performs, right? Same thing with our accumulation products. Works the same exact way. So this is assuming I put $300,000 into a policy on the left-hand side of your screen, and it grows pretty conservatively at 2% compound interest each year. At the end of 10 years, I've got $365,000. Not great, not bad. It's growing. I haven't lost any money. The other account, though, is our benefit base. And that's how we supercharge the income for the client. With this, we're giving them a 25% bonus immediately. And then every year that they wait to turn on income, we're going to give them another 10% on top of it every year. So this really only works from a 10-year standpoint. I would say it looks even better between 5 and 3 years is really the sweet spot for this product. So if somebody's going to retire in really 1 to 5 years, this product stands alone on a mountain for us at National Life Group. This is one of the best income products in the industry today because of that. So the big differentiator here is I don't even think there should be a dollar sign next to this right here. It's not real money. Think of it like Monopoly money. I can't go spend it anywhere. I can't take it to the supermarket and buy my groceries with it. This account over here, the benefit base, like I said, is just how National Life is figuring out what your income is going to be. So day one, I get that 25% bonus. And now I've got $375,000 in my account, but it's not excessive. It's just what we're doing to figure out how much National Life will pay you. Then I wait every year that I wait, I get an extra 10%. At the end of the 10th year, I've got $750,000 in that account. Now, if I pass away, I'm getting the 365, or my beneficiaries are getting the 365. The 750 though is going to be determined, or how we're going to determine how much we're going to pay the client. Now, the payouts on these annuities are based off of the age of the client. So as I get older, this guaranteed withdrawal percentage over here on the right-hand side at 65, that'll increase. As I get older and older and older, it'll be more and more and more of my money that I can access. But once I start taking income, it's locked in at that amount. So for this case, we're going to base the income off of 750,000 instead of 365. So I'm going to get about $42,000 a year in guaranteed income, regardless of how the S&P has performed. And that's the power of this product, and that we haven't taken into account on the right-hand side how the S&P or the global balance or the US fundamental balance indexes have returned. Doesn't matter. You're guaranteed that 25% bonus day one and 10% roll up every single year. Now, how it works when I start taking money out is what you see on the left-hand side here. So I pull my $42,000 out, my account value drops, I get an interest credit maybe, and then we take out the rider fee. And the rider fee is 1% of this benefit base. Important differentiator there. So at the end of the year, I still have $322,000. If I pass away, that's what my beneficiaries will receive. If I decide, hey, I'm just going to cash it out, I don't want this annuity anymore, we've got $322,000 there. Now, sorry, I clicked ahead. With this annuity, I think the biggest benefit that you have for somebody, I already said it, is that it's guaranteed. So I could show somebody an illustration right now. National Life receives that check or that rollover from that other company. I can tell my client they're getting $42,000. That's exactly what they're going to receive, regardless of the market. So if S&P is flat or down the next 10 years, does not matter. We've contractually guaranteed them the 10% roll up every year they wait, 25% bonus immediately. As long as we get that money in-house, client knows exactly what the income is going to be. One of the nicest things, and I wish I took a screenshot of it for these slides for you guys, is when you run an illustration with this product, you can actually see what the income would be if they took it earlier as well. So you could show them, hey, you could take it after 5 years and it'll be, I'm making up a number, so don't hold me to this, it'll be $27,000 a year. Or you could take it in 3 years and it'll be $18,000. Or you could take it in 30 days and it'll be $12,000.
Jake,
That's the, yeah.
all right. So is that on the illustration that I can
It
show?
is, yes.
Okay.
And if we have time, I do want to get into the software for you guys so that way we can show that.
Great.
Julia, for all of these single premium products that I'm going over, the minimum is 25,000 for them to deposit. 60,000 if they want to use that dollar cost averaging feature, but 25 just to get the product itself. So the other piece of this, and I'll make sure that we can get into the illustration software because I want to show you guys. You know, you have a guaranteed and a current ledger on the IULs, right? Guaranteed your worst case scenario. We're charging the highest possible expenses. We're showing zero return from the indexes. I would rather show the guaranteed ledger on this annuity because it shows them that. And regardless of how this policy performs, it will not change what your income is going to be on the guaranteed side or the current side based off of the interest rates of today. So it's really that set it and forget it product for those people close to retirement that are like, I know what I'm going to get from my other retirement assets. I'm maybe going to get Social Security if it's still around. I want to know exactly what the dollar amount's going to be. I'm on a fixed income. I need to know that I'm getting $3,000, $4,000, $5,000 a month from this annuity for the rest of my life without ever having to worry about running out of money. This is the income driver, Juliana. So income driver, guaranteed, short-term, people close to retirement. That's really the best sweet spot for this product. And it's for those individuals, again, looking for guaranteed income. This is not the people that, hey, I've got a couple $100,000 in an old IRA or 401k. Let's move it into annuity so that way it's safe. I'm not losing money, but I want to leave it to my family down the road. I don't need this for supporting my retirement. That's really for somebody that's looking for, I need this dollar amount to support myself in retirement from these retirement assets I've accumulated. Zenith income, though, on the other hand, and I'll pause there. Does anybody have questions for me on income driver?
Can they
Zenith,
make more deposits, Jake, or it's just a one-time deposit?
it's just one time. We can accept multiple transfers, though, for up to 90 days. So if we've got money coming from a couple of different institutions, we can accept it up to 90 days after we issue the contract. But say they've got extra money a year or two down the road, they would have to open up a second account. Any other questions on income driver? I will say income driver is what I'm talking about most. It really is one of the most competitive products in the industry for single premium annuities for a short time horizon. All right, I'll get it in chat if you guys want to ask any more. So Zenith income, on the other hand, is longer term. Freddie has a good question on the other side. What's the maximum deposit? We say 3 million, but if you have more than that, call me or Lindsay or David Gilmore. We'll get it approved. We are definitely okay with larger deposits. So Zenith income is a little bit more complicated of a product, and that I don't see the best use case for it, to be honest. Not that it's a bad product. It's just that with both of these income products, Zenith income and income driver, I'm paying 1% for that guaranteed income rider. And that can build up to a pretty big charge over my lifetime. If I've got more than 10 years for retirement, I would much rather see somebody have a client go into Growth Driver 10 or the Zenith Growth product and accumulate money and roll it into an income product down the road, instead of purchasing an income product where you're paying the 1% for 15, 20, 25 years. But with that being said, Zenith income is built for income long-term. So I've got more than 10 years, 15, 20 years that I'm going to wait, let this money sit and grow and accumulate, and then turn on income. To make it more complicated for you guys, this product has 2 income riders. There is a max bonus and a split bonus option. The max bonus is exactly how it sounds. We're going to give you a bonus based off of the time frame that you've held the product, and it's really going to maximize your income down the road. Split bonus is kind of the best of both worlds. You're going to get a 5% immediate bonus, but your bonus on the back end when you start income is lower. I would almost ignore split bonus from your mind. If somebody's not sure about taking income, don't sell them an income product. They're going to call you 2, 3, 4, 5 years down the road and complain that you've got a fee on this product when this other product doesn't have a fee. If they're not sure, go to one of the accumulation products. And then we could always figure out rolling again into an income product down the road, like Income Driver, that they can start income on in a really short period of time. Max bonus, though, is really what this product's probably built for, in that the longer I hold on to this policy, the bigger my bonus is going to be when I start income. Biggest thing I will say is this is not a cash value bonus. It is an income bonus. So if I have $1 million in my account and I hold on to this thing for 21 plus years, I'm not going to have 200% of my $1 million in the account. It's going to be based off of the income we're generating. So let's just say based off of my cash value, we have that same calculation of based off my age, I've got that withdrawal percentage. Let's say I'm getting $10,000 a year from my policy. We will take that activation bonus and apply it to the income, not your cash value. So a little bit confusing there, I think, for some clients when they see it, and that it's, hey, I'm going to get 170, 200% of my policy. It's not. It's just how we're going to calculate what their income is going to be, similar to the other bonuses that you saw on the income driver. So here's kind of your opportunity cost, if you want to look at it that way. If you choose max bonus with the same deposit, I've got 25,000 less in cash value compared to the split bonus, but I've got about 3,000, a little bit more than that, more in income a year. I would say, again, max bonus is where this product fits best. This, to me, from a client standpoint, is going to be the client that doesn't want to touch it. That's 45, 50 years old, has 15, 20 years until they're going to retire, but just wants to set it, forget it. And they know that they're going to hang on to it for a long period of time and really optimize what their income is going to be by getting as much as they can out of this activation bonus. But like I said, for me, if I've got somebody that's 45, or even if I've got somebody that's 50, I may just put them into an accumulation product. Give them a bonus with the growth driver, or just put them into a product with really great rates to it, like the Zenith growth, and let them build and accumulate some wealth. And then when I'm closer to retirement, you got a 50-year-old, let's revisit this at 60 or 62, 63, see where you're at from a retirement planning standpoint, and figure out, we're not going to have the same products we have today. Figure out what next great product we have on the marketplace then, and roll it into something that create guaranteed income for them. So like I said, income driver is what I'm talking about most. Then it's probably growth driver because of the bonus, and that we're doing a lot of work right now with people close to retirement. They want that bonus. And then Zenith growth is probably that third product that we talk about. Outside of that, we probably don't sell a ton of Zenith income. So just know that it's a tool for you to use, but I would say income drivers where most of the income products you're going to sell are going to be. All right, so I'm just going to reiterate it again. So income driver, guaranteed. We know exactly what it's going to be, regardless of how the S&P performs. Zenith income, really that long term. I'm optimistic I'm going to get returns from the policy. I don't have guaranteed bonuses or roll-ups though. I have that activation bonus, but it's completely reliant on the cash value performance of the policy. So I put $500,000 in. We're going to see how that grows over the next 10, 15, 20 years. Hopefully I've had good returns. And then we're going to base the income off of that cash value. All right, with all of our income products, this is true on the next couple of products I'm going to go over too. We do have our income doubler. So just know that if they can't perform 2 out of 6 activities of daily living permanently, we will double their income for up to a 5-year period. So again, the living benefits, the puzzle piece, this is similar to that chronic illness type wording. We have a solution for that on the annuity side. We'll give you double your money for 5 years if you can't perform those 2 out of 6 ADLs permanently. So a great option for them. And this is available in all states. It wasn't available in California up until recently. It is now available in California. All right, so those are the single premium products. I'm going to talk really high level about the flexible premium products. Just for the sake of time, I want to get into the illustrations for you guys. We have 3 flexible premium products, and how these differ is that I have that $25,000 minimum on those products we just covered. These we can accept as little as $100 a month, and those will be recurring premiums. So Julie, to your point, can these accept ongoing? These are the products that can accept ongoing contributions. Or I could treat it as a single premium product. Say you have that client that's got a smaller 401k that doesn't maybe meet that 25,000. You know, they were only there for a couple of years and then they left. We can take a minimum of 5,000. If they want to just treat it as a single premium, not put any more money in, they have the option to put money if they want to, but it's an alternative from you saying, okay, well, we can't do income driver, we can't do growth driver, we can't do any of the single premium. $10,000, $15,000 doesn't fit their minimum. It does with these products. And we don't require them to put that $100 a month in if they meet that 5,000. All right, I saw some chats come through. So well, income products and rollover have an additional 5% bonus. So well, all income products. So no, the only product that has a bonus for a rollover is going to be our Flex Secure Growth right here in the middle. Or if you choose Zenith Income and you choose the split bonus guaranteed income rider option, they have to choose which one of these they want when they issue the contract. That will give them a 5% cash bonus. And for income doubler, should I select it when I do the application, or can it be requested later? Juliana, it is just you would want to select it. There is a charge for it though, so that's important to understand. I think you're adding another 1% fee onto the product to have the income doubler, so just keep that in mind, but I think you do have to select it on application. Julia, you've got a 44-year-old with 5,000 in old 401k. Perfect. We're going to talk through that. So it depends on what their goal is, but I would say you have a similar type of story with these products right here that you have with the single premium products. You've got Flex Secure Growth, you've got Flex Secure Growth Bonus, and then you've got Flex Select Income. Flex Select Income is Zenith Income, just in a single or a flexible premium product. So I could put ongoing contributions into it. It's got the 2 income rider options. I've got max bonus and split bonus, and I've got an accumulation vehicle there for income down the road. So that is an option for that person if they want to hold on to it for a long period of time and have those ongoing contributions to it, or just have the 5,000 and create guaranteed income. There is a rollover minimum of 5,000 into these 3 if you're going to do a rollover. If it's lower than 5,000, say if you have a $2,000 or $3,000 old 401k, they're going to have to do the ongoing $100 a month for a period of time. So the other option for you, Julie, is you got a 44-year-old, they're probably 20 years out from retirement. We could give them a bonus product. On Flex Secure Growth Bonus, they get a 5% immediate bonus, as well as bonuses on every new premium they contribute for the first 8 years. The only downside to that is you've got slightly lower rates on the Flex Secure Growth Bonus than you do on the Flex Secure Growth. So for a 44-year-old, Flex Secure Growth is probably the best option. Let them put 5,000 in. There's no fees to it. Let them accumulate some money over the next 15, 20 years, and then roll it into maybe a single premium product with a bonus or an income product down the road. All of these, or at least the 2 in the green, the accumulation products, no fees to them. You just have an accumulation product with good rates, and then you've got an accumulation product with a bonus. Same thing that we had on the accumulation side for the single premiums. Now, Claudia mentioned this before. It's a great pivot for you all when you have that client that's uninsurable, where we can't do a life insurance contract because of their health history, but they're wanting to give you $1, $2, $3, $4, $5, $6, $7, $800 a month, whatever it is. You got to have a pivot there. And these products are a perfect pivot. It doesn't have the same tax-free benefits and things like that that we have on the IUL side. I don't have a death benefit immediately. I've kind of got living benefits if you want to kind of spin it that way. But if it's really that client that's looking for that index account and having that upside potential and saving for retirement, this is where these products fit really well. And that it's really just based off of their needs. Flex Secure Growth is probably the easiest thing to sell to kids that are uninsurable, to somebody that's in their 20s, 30s, 40s, even probably 50s, where they've got great rates to it, upside potential. I'm never going to lose a penny. Where I would probably pivot with the Flex Secure Growth Bonus is for those people that are closer to retirement, just like we would on the growth driver. I'm getting a bonus. I'm getting a little bit less for rates. So over a long period of time, Julia's client was 44 years old. I'm probably not going to touch the money for 20, 21 years. So the bonus really won't make a difference for me. I'm probably going to have less cash value if I choose that bonus product because I'm giving up 1 or 2% on the cap. And then we get to Flex Select Income. Flex Select Income, in my mind, it's for those people that, again, uninsurable, but want to save for retirement and create guaranteed income. Maybe they don't have that dollar amount to get to a single premium product right now. Let's get them started on this and then be able to generate guaranteed income for them down the road. let's see. I know that you guys had a couple more questions come through. Jackie, is it possible to do more than one rollover into the same product? You can. Jackie, with our single premium products, so the Zenith and the Driver products that I went over, those can accept rollovers for up to 90 days. After 90 days, though, we shut it down. They'd have to open up a new account. With these flexible premium products, they could do rollovers into them for the first 5 years. So if all of a sudden the client's like, oh my gosh, I forgot I had money over here, can we roll it into my IRA? As long as it's IRA money to IRA money, you're good. You can roll that into these products for a couple of years after you issue them. Oh, Juliana, we can show that in the illustration. I'll do that actually next. This is my last slide here. And we'll go over income doubler a little bit more. Juliana, no, I believe that I'd have to double check for you, but I don't believe that annuities are free from creditors like an IUL. It's not a life insurance contract, it's an annuity, so they're treated a little bit differently. But I'll confirm that and follow back up with you guys. And Soraya, rollovers, but not add cash, right? It depends, Soraya. So if I have a non-qualified annuity, so say I've got money from multiple institutions and it's non-qualified money, so it's after-tax dollars. You could technically, with a single premium product, take, let's call it 5 grand out of your bank account, and then 20 grand out of wherever that money is sitting that's non-qualified, and add them together. Those are technically rollovers in our mind, but it's just cash on hand out of your bank account. For these flexible premium products, though, I can add money at any time. Rollovers are coming from another institution, another insurance company, another financial institution like a Schwab or Edward Jones or wherever. Those are considered rollovers, where it's truly coming from same product or same plan type into National Life. So if it's just me paying money out of it, most of your cases that are going to be uninsurable, they're probably going to do non-qualified. Unless they want a tax deduction, which they could do an IRA, or we could go through the whole Roth IRA scenario. But if I'm just paying out of my bank account, I could do a rollover into this annuity, pay out of my bank account, and then maybe I've got non-qualified somewhere else. I could do a rollover for that money from that other financial institution and bring it over to National Life Group within those first 5 years. So if you ever have that case, and you've got money where it's like, we issued this product 3 years ago, we want to do a rollover, come to us, come to our sales desk. We can help navigate that for you. It's pretty uncommon. Most of the time, you're getting most of the client's financial information as you're going through that initial application, unless maybe they open up account on the side and they're like, I want to consolidate and bring it over. But we can work through that if you guys ever have something like that. So Jackie, we're actually going to get into the income doubler right now. We're going to talk through it on the illustration software. Bear with me. I got to log into the portal really quickly for you guys.
Jake, a quick question. On the
Yes.
existing annuity, can you change allocations like we do on the IUL?
Absolutely. Yep. So it's the same process.
Can I do that on the app, or is something that has to be done through with National Life directly, or through email, or?
I believe that there's going to be a form that you have to fill out, Claudia. I don't know if they have the annuities live for the mobile app to change allocations, but I might be wrong. It might be up and running right now. But it's just a change of allocation form, and then you'll be able to adjust those as you want to with the annuity side. But remember, it's just like on the IULs. If I pay my money into this annuity, 6 months down the road, I change allocations, I'm going to have to wait for that full crediting cycle before my money will get reallocated. So I pay, 25 grand into a policy today. In December, I'm like, I want to switch. We're gonna have to wait for that money to get credited in July of 2026, and then we'll reallocate to those new strategies. So typically we give a window of about 30 days prior to that anniversary date for you all to change those allocations on the annuity side.
Thank you.
You're welcome. All right, so with the annuity illustrations, hopefully you guys have noticed, we did separate them out. So you do have to go to the annuity one to get to the annuity products instead of just all in one like we used to have. With these products, you're going to be able to do the same thing that you do on the life insurance side. You can pivot between the different options. I just went through our indexed annuity portfolio today. Know that we also have fixed product as well. So these are locked in interest rates for that surrender period. We've got a 3 and a 5 year. These are called MIGAs, so multi-year guaranteed annuities. These are more of a commodity product. Rates are not fantastic right now, so we're not seeing a lot of usage of them industry wide. But if you've got that client that's like, I want to guarantee for the next couple of years, a MIGA is a great option. It's fixed. They know what the interest is going to be, and it's a short-term bridge for them to figure out what they want to do with the money. You know, it's a great CD alternative if they got money in the bank and a CD, and they don't need access to it right now. So just know that those are available as well, but I really wanted to focus on the index annuities for you guys today. All right, so I'm going to go to income driver. I'm going to do this for a 60-year-old. You can change the plan type up here if you wanted to. So if we're doing on a 401k and rolling it into an IRA, we can show that. It will not change your illustration though. So just know that we don't do anything from taxes on the illustration. So you can just leave it as non-qualified. It'll run the same exact way, but just from professional sake, just make sure you're matching up that plan type for your client. All right, so let's just say this client has about $250,000 that we want to roll into this annuity. This is where I'm going to put it right here in the single premium product. If you ever want to change the surrender period, you can. Just know that if you look down here, you will see what the S&P point-to-point cap is or all the other strategies. If I change it to 7, I am manipulating that rate because of the surrender period. So you will see a little bit of a dip there if you choose one of the shorter surrender products. I'm going to leave it as 10. And then I'm just going to put 100% into our S&P point-to-point strategy. You could illustrate that dollar cost averaging here. I am not, but for a 60-year-old, I probably would and just put 100% in here. I'm just going to leave it alone for right now. With the annuities, one thing that's unique compared to your IUL strategies is that you need to tell us where we want to allocate this money to. And one thing I didn't cover on the PowerPoint was I kind of went briefly over the different strategies. Just know that we have pretty convoluted when it comes to index strategies on the annuity side. You have 1-year strategies, you have 2-year strategies, and then we have what we call our rate booster strategies. Rate booster adds an added fee to this product. And that's why I say use it at your discretion. It's not going to be for everybody. You can see that my S&P cap is 8% here. I'll zoom in a little bit so you guys see it better. My S&P cap is 8%. If I decide to use the rate booster, the 1 year, I get a 10% cap. If I decide to use the 2-year strategy, I get a 17% cap. If I decide to use the 2-year with the rate booster, I get a 21% cap. It adds complexity to the product though. So like I said, use it at your discretion. I will show you one thing really quickly, just as a err on the side of caution when you're using these. I'm going to go to growth driver really quickly. I'm just going to keep it as a 55, or I'm not going to do anything crazy. Put our same 250 in there. And I'm going to put 100% in the S&P point-to-point. And we're just going to look at the cash value really quickly. So this is just an accumulation product. I want to show you, I've got a 10.5% cap. It's pretty reasonable for me to say, okay, 10 years, I've received 1, 2, 3, 4, 5, 6, 7 interest credits and 3 zeros. Pretty conservative. And I've got now almost $500,000. I've almost doubled my money in that time frame. If I decide I'm just going to go crazy and I'm going to put 100% into the 2-year strategy with the rate booster on our global balance index. One thing I really want you guys to pay attention to is years like this. this is not a realistic annuity illustration. Annuities have credited on average somewhere between 5 and 7%, depending on the product that you're looking at. If you're ever in competition and you see something like this is where you can poke holes into it. You're not going to receive 65% interest crediting. That's just insane to think. I'm at significantly more cash value because of it. I'm also not receiving interest credits every year. I'm receiving them every other year because of that 2-year strategy that I chose. So you can see that I'm being charged 1% for the rate booster, and then I get a credit. And then I skip a year, and then I get a credit, skip a year, get a credit. This was a down year, so I didn't get anything. I didn't get any interest credits on that 2-year strategy for 4 years. And then I get a credit again. So you could make these illustrations, to be honest, look silly and have some crazy interest credits to them. Annuities are really conservative though. So use that as kind of ammo in your pocket if you ever have a client that's got another advisor in their ear and they're showing them crazy illustrations like that. We can help with that, help coach you guys. If you got a copy of that illustration, we can always help you. But honestly, going with the S&P 1-year strategy, it's not a bad thing to do for your client. Or if you want to diversify a little bit and put maybe a couple of different strategies, they're going to perform long-term really similarly, just differently depending on the market environment we're in. All right, so once I've done that, income driver does come with an option where you can choose no fee for the income rider. It removes that 25% bonus though. So remember, that's really what's going to supercharge this product for this client that's close to retirement. I don't ever see this product being used without the fee. The 1%, you're paying for 25% bonus. That's really what this product was designed for. I always will choose that charge option. Now, from here, I honestly don't have to do anything else. It's that simple. So I could actually just run the report right now. You can see here are my guaranteed elements. I got 250,000. What's my guaranteed cash value, my benefit base, my income?
We're not seeing your next screen.
Oh, sorry. Thank you. I think because I was sharing the window. Can you guys see it now?
Yes.
Perfect. Okay. So left and right side, I've got my guaranteed and my non-guaranteed on the right. Guaranteed is just showing, again, no interest credits. The best thing you can point out, I don't even have to leave. This is the second page of the illustration. I don't have to leave this page to show them your income is going to be exactly the same. I've got 24,000 here. I've got 24,000 here. And that's just assuming at age 65. Where we could go even deeper, I'm just going to scroll down a couple pages here for you guys just to get to the guaranteed ledger. So here we've got our guaranteed elements. Worst case scenario, I'm getting 0 interest credits. I'm being charged 1% for the income rider. If we just look at age 70, 69, 70, I get $35,922. If I scroll down to our current, which is again, it's assuming the rates that we were showing on the S&P 500 1-year point-to-point strategy. Here's my income, $35,922. Yes, I've got better cash value because we're assuming that. We don't have that crystal ball. We don't know what it's going to be. We're using a 10-year look back with the S&P. But that's the power of this product, in that I could show this to a client, get that rollover into National Life Group and say, oh, well, you're planning on retiring at 69, 70 years old. We can guarantee you $35,922 for the rest of your life if you wait that long. Or if things change, let's maybe say they retire early. They want to retire at 65, 66. Well, now we're at $26,484. So it's not a lock-in guarantee. They don't have to say, I'm going to take income at this point in time, just like an IUL. We don't know when that client wants to access their funds or if at all. So they're going to let us know when they want to take income from these policies. They could wait 30 days and take 16 grand. You know, they got a big inheritance or check from somewhere. I don't know. They've decided, though, that they don't need to work the next 5 to 10 years. They're going to just use this money to help supplement whatever other funds that they have. So use this, or really use this as a tool and showing them that, you know, there's a lot of volatility in the market right now. S&P's at all-time highs. Like, we don't know what's going to happen, but I know exactly what your income is going to be. So regardless of what's happening in the economy, in the world, in the global markets, I could show you exactly what this annuity is going to pay you in retirement. And that's really the best case for this type of product with Income Driver. Now, if I were to actually choose guaranteed income, and let's just say I want to start it at age 65, and I want to choose the income doubler. What this is saying is I'm assuming we're going to start taking in doubled income at some point in time. So to the questions in the chat of using this in the illustration, it is 100% hypothetical in assuming when this client can't perform 2 out of 6 activities of daily living. So in this case, we could say, okay, well, 5 years after I start taking income, at age 70, I want to show this client receiving doubled income. But again, it's completely reliant on them qualifying for that doubled income. And it's just showing an illustration of that. So you can see here, I receive it 1, 2, 3, 4, 5 years, and then I've run out of money at that point. And we go back to our original income amount. So income doubler is a way to just show it on the illustration. It's nothing more than that. It's just a way for you to show it. That's all.
Jake,
Yeah.
all the products comes with a doubler income, all the products that we spoken. So we don't
Yes.
have to choose in when we're doing the illustration, but let's say along the way, if happens, we are able to request for this doubler income, right?
Yes. Yeah. So
Because you said that there's a charge, so I was a little confused with that.
I misspoke there. So there's no charge for income doubler.
That's what I thought. Okay.
Yeah, that's my mistake. So there's no charge for income doubler.
Okay.
The income doubler that you see right here is just to show it on the illustration. It will come on the policy automatically.
Okay.
I forget what I was thinking about, had a 1% charge, but no, the income doubler will not. If you choose no on this, and you don't need an illustration either with the annuities. So as you're going through your applications on the rollover side, we don't need a signed illustration. It does not matter to us at National Life Group or industry standard. You don't need a signed one. It doesn't come with the policy package. So for this, you can see like, I don't have any way to get into EAP over here on the left-hand side. I'm going to have to go into IGO EAP, start a new case, and then go from there through the annuity side.
Thank you.
Does anybody else have any questions for me? I have a 1 o'clock, so I need to jump off pretty quickly here, but thank you guys for all the questions. Hopefully this was helpful to you. If you guys have questions, I'm more than happy to jump back on another session with you guys or do another one. Or just give me a ring. I'll be tied up for the next little bit here, but I'll be available this afternoon and the rest of the week.
Jake, thank you so much. I think based on what you showed, that probably would be amazing if you could come for a second session.
I would love to.
Just maybe work more on the illustration sides for people to see it. I'm
Sure.
going to talk to Gustavo to just make sure, because today I kind of stole this time from another training, but I'm going to check another time and check with your availability, and then we go from there. But I want to thank you for your time again. This, guys, is going to be on the app as soon as Victoria is able to put it there. Life Changers, that's going to be on our platform. So anything you guys need, you know, talk to your field trainer, talk to your black jacket, or as Jake is saying, he's available this afternoon. If you have a case, not an idea, but a case, a real case, and you need, you know, some kind of help, you can ask him as well. Thank you so much, Jake, and we'll talk to you soon to see when you can come back to work on the illustrations with us.
Sounds good. Thank you, everyone. Have a great day.
All right. Gente, só um minutinho. Deixa eu parar de gravar aqui.